Welcome back to another summary audiobook. Today we're diving into what many consider the Bible of options trading, Lawrence McMillan's Options as a Strategic Investment. This book is not just a trading manual, it's a comprehensive guide to thinking strategically about financial markets. The book teaches you that options aren't gambling instruments or get-rich-quick schemes. They're sophisticated tools that, when used properly, can enhance returns, reduce risk, and provide income. Let's dive into, right now, as you're listening to this, thousands of retail investors are losing money in the options market, not because they're unlucky, but because they don't understand what they're doing. They're treating options like lottery tickets instead of sophisticated financial instruments. McMillan warns us that options can be your greatest ally or your worst enemy, depending on your knowledge level. So buckle up, because over the next 3 episodes, we're going to transform you from an options novice into someone who thinks strategically about these powerful tools. Lawrence McMillan isn't just another Wall Street guy trying to sell you dreams. He's been in the trenches for decades, and his book has been the go-to resource for professional traders since the 1980s. What makes McMillan different is his systematic approach. He doesn't just tell you what to do, he explains the why behind every strategy. As McMillan said, the successful option trader must understand not only how to implement strategies, but when to implement them, and, equally important, when not to. This isn't about get-rich-quick schemes. This is about building a sustainable approach to wealth creation. Understanding options basics. Let's start with the fundamentals, because as McMillan emphasizes, you can't build a house without a solid foundation. An option gives you the right, but not the obligation, to buy or sell a stock at a specific price within a certain time frame. Think of it like this. Imagine you're house hunting and you find a property you like, but you're not sure if you want to buy it yet. You could pay the seller a small fee to hold that house for you at today's price for the next 30 days. That fee is like an option premium, and that holding period is your expiration date. McMillan breaks options into 2 basic types: calls and puts. A call option gives you the right to buy a stock. You're calling it away from someone. A put option gives you the right to sell a stock. You're putting it to someone else. But here's where it gets interesting, and where McMillan's wisdom really shines through. He explains that there are 4 basic positions you can take with any option. 1. Buy a call, bullish. 2. Sell a call, bearish to neutral. 3. Buy a put, bearish. 4. Sell a put, bullish to neutral. The Greeks, your risk management tools. Now, Lawrence McMillan dedicates significant attention to what traders call the Greeks, and for good reason. These aren't just academic concepts, they're practical tools that can make or break your trading success. Delta tells you how much your options price will change when the stock moves by $1. McMillan explains that delta is like the speedometer in your car. It tells you how fast you're going, but not where you're headed. Gamma measures how much delta will change. Think of gamma as your acceleration pedal. McMillan warns that gamma can be particularly dangerous for option sellers because it accelerates against you when trades move the wrong way. Theta represents time decay, how much value your option loses each day. McMillan calls Theta the silent killer of option buyers because it works against you every single day, even when you're right about direction. Vega measures sensitivity to changes in implied volatility. As McMillan points out, you can be completely right about a stock's direction and still lose money if volatility drops unexpectedly. Covered calls, your entry point. Let's talk about your first real strategy, the covered call. McMillan considers this the most conservative option strategy, and it's where many successful traders begin their journey. Here's how it works. You own 100 shares of a stock, and you sell someone else the right to buy those shares from you at a higher price. In return, you collect a premium. Lawrence McMillan explains that this strategy works best when you're mildly bullish on a stock, but don't expect dramatic price movements. Let's say you own 100 shares of Apple at $150 per share. You could sell a call option with a $160 strike price expiring in 30 days and collect, say, $200 in premium. If Apple stays below $160, you keep both your shares in the premium. If Apple goes above $160, your shares get called away, but you still profit from the stock appreciation plus the premium. McMillan emphasizes that covered calls are not about maximizing returns. They're about generating consistent income while maintaining stock ownership. He warns against getting too greedy with strike price selection. As he puts it, the covered call writer should be content with reasonable returns, rather than trying to squeeze every dollar out of each position. Cash-secured puts, building positions. The cash-secured put is the flip side of the covered call, and McMillan treats it as an equally important foundational strategy. Instead of owning stock and selling calls, you're holding cash and selling puts on stocks you'd like to own. Here's the psychology behind it. Instead of placing a limit order to buy a stock at a lower price, you sell a put option and get paid to wait. McMillan explains that this strategy works best when you have a genuine interest in owning the underlying stock. Using our Apple example again, let's say Apple is trading at $150, but you'd love to own it at $140. Instead of just placing a limit order, you could sell a $140 put option and collect premium. If Apple drops below $140, you'll be assigned the shares at $140, but your effective cost basis is even lower because you collected the premium. If Apple stays above $140, you keep the premium and can repeat the process. McMillan warns that the biggest mistake beginners make with cash-secured puts is selling puts on stocks they don't actually want to own. Remember, assignment is always possible, so make sure you're comfortable owning the underlying stock. Risk management principles. Before we wrap up part 1, let's talk about risk management, something McMillan considers more important than any individual strategy. First principle, never risk more than you can afford to lose on any single trade. McMillan suggests that no single position should represent more than 2 to 5% of your total portfolio value. Second principle, have an exit plan before you enter any trade. McMillan is adamant about this. You need to know when you'll take profits and when you'll cut losses before you put the trade on. Third principle, understand assignment risk. When you sell options, you're taking on obligations. McMillan explains that assignment can happen at any time, but it's most likely when options are in the money near expiration. Fourth principle, don't ignore transaction costs. McMillan points out that option strategies often involve multiple legs, and commissions can eat into profits quickly if you're not careful. Setting up for success. As we conclude part 1, remember what Lawrence McMillan emphasizes throughout his book. Successful options trading isn't about finding the perfect strategy. It's about implementing good strategies consistently with proper risk management. Now we're going to dive into more advanced strategies like credit spreads, debit spreads, and straddles. We'll explore how to profit from volatility and time decay, and McMillan's insights on when to use each strategy. But for now, your homework is simple. Paper trade some covered calls and cash-secured puts. Get comfortable with these basic strategies before moving on to more complex approaches. As McMillan always says, master the basics before attempting the advanced. Thanks for joining me for part 1 of our journey through options as a strategic investment. Don't forget to like this video, subscribe for more content, and I'll see you in part 2 where we'll unlock the real power of options trading. So far, we covered the basics and simple strategies like covered calls and cash-secured puts. Now we're stepping up our game with credit spreads, debit spreads, and volatility strategies. These are the tools that separate casual option traders from serious strategic investors. Understanding spread strategies. Lawrence McMillan dedicates several chapters to spread strategies, and for good reason. Spreads allow you to define your risk precisely while still maintaining profit potential. As McMillan explains, spread strategies are the backbone of professional option trading because they offer controlled risk with reasonable profit potential. Let's start with credit spreads, one of McMillan's favorite strategies for generating consistent income. Credit spreads, collecting premium with defined risk. A credit spread involves selling a higher premium option and buying a lower premium option of the same type. The key word here is credit. You collect money up front when you open the trade. Bull put spreads. This is McMillan's preferred strategy when you're moderately bullish on a stock. You sell a put option at a higher strike price and buy a put option at a lower strike price, both with the same expiration date. Let's use a practical example. Say Tesla is trading at $200 and you're mildly bullish. You could sell a $190 put for $3 and buy an $80 put for $1, creating a bull put spread for a net credit of $2 per share or $200 per contract. Your maximum profit is the credit received, $200, which you keep if Tesla stays above $190 at expiration. Your maximum loss is the difference between the strikes minus the credit received, $190 minus $180, minus $2 equals $8 per share, or $800 per contract. McMillan emphasizes that the beauty of this strategy is the high probability of success. You profit as long as the stock doesn't drop more than about 5% by expiration. Bear call spreads. This is the opposite approach for when you're bearish or neutral on a stock. You sell a call option at a lower strike and buy a call option at a higher strike. Using Tesla again, if you think it won't rise above $210, you could sell a $210 call for $3 and buy a $220 call for $1, collecting a net credit of $2. You profit if Tesla stays below $210, and your maximum loss is limited to $8 per share. McMillan warns that timing is crucial with credit spreads. He recommends entering these trades when implied volatility is elevated, as you're collecting more premium, and closing them when you've captured 25 to 50% of the maximum profit, rather than holding to expiration. Debit spreads. Limited risk, limited reward. Debit spreads are the opposite of credit spreads. You pay money up front but have limited risk. McMillan considers these excellent strategies for directional plays when you want to control risk. Bull call spreads. When you're bullish but want to limit your cost, McMillan suggests buying a call at a lower strike and selling a call at a higher strike. You pay a debit up front but cap both your risk and reward. Let's say Microsoft is at $300 and you're bullish but don't want to pay the full premium for a $300 call. You could buy a $300 call for $8 and sell a $310 call for $4, creating a bull call spread for a net debit of $4. Your maximum profit is the difference between strikes minus the debit paid. 310 minus 300 minus 4 equals 6 per share. Your maximum loss is limited to the $4 debit paid. McMillan points out that debit spreads work best when you have a strong directional opinion and want to reduce the cost of being wrong. Iron condors, the income generator. Now we get to one of McMillan's most discussed strategies, the iron condor. This is essentially combining a bull-put spread and a bear call spread on the same underlying stock with the same expiration date. An iron condor profits when a stock stays within a specific price range. You're betting that the stock won't move too much in either direction. McMillan describes this as selling volatility. You're collecting premium by betting that the market's expectations for movement are too high. Here's how it works with Apple trading at $150. Sell a $140 put for $2, buy a $130 put for 50 cents, sell a $160 call for $2, buy a $170 call for 50 cents. Your net credit is $3 per share, $300 per iron condor. You profit if Apple stays between $140 and $160 at expiration. Your maximum loss is $7 per share, $700, which occurs if Apple moves below $130 or above $170. McMillan emphasizes that iron condors work best in low volatility environments when stocks are trading in predictable ranges. He warns against using this strategy around earnings announcements or major news events. Straddles and strangles, volatility plays. Sometimes you know a stock is going to move significantly, but you're not sure which direction. That's where straddles and strangles come in. Strategies McMillan calls volatility plays. Long straddles. You buy both a call and a put at the same strike price and expiration date. You profit if the stock moves significantly in either direction. McMillan explains that this strategy is like betting on an earthquake. You don't care if the ground moves up or down, just that it moves a lot. Long strangles. Similar to straddles, but you use different strike prices, typically buying an out-of-the-money call and an out-of-the-money put. This costs less than a straddle, but requires more movement to be profitable. McMillan warns that timing is everything with these strategies. You want to buy straddles and strangles when implied volatility is low, and sell them when implied volatility is high. He also emphasizes that these strategies suffer from time decay, so you need the big move to happen quickly. Short straddles and strangles. These are the opposite. You sell both options and collect premium, betting that the stock won't move much. McMillan considers these advanced strategies with unlimited risk that should only be used by experienced traders with proper risk management. Calendar spreads. Time is money. Calendar spreads involve buying and selling options at the same strike price, but different expiration dates. McMillan explains these as time spread strategies where you're trying to profit from the passage of time. A typical calendar spread involves selling a near-term option and buying a longer-term option at the same strike price. The idea is that the near-term option will decay faster than the longer-term option, allowing you to profit from the difference. McMillan points out that calendar spreads work best when the stock stays near the strike price of the options. They're relatively low-risk strategies but require patience and precise timing. Volatility trading insights. One of McMillan's key insights is understanding the difference between historical volatility and implied volatility. Historical volatility measures how much a stock has actually moved in the past, while implied volatility reflects the market's expectation of future movement. McMillan explains that successful option traders look for discrepancies between these two measures. When implied volatility is much higher than historical volatility, it might be a good time to sell options. When implied volatility is unusually low, it might be time to buy options. He warns that volatility tends to cluster. Periods of high volatility are often followed by more high volatility, and periods of low volatility tend to persist. This is crucial for timing your volatility trades. Position sizing and risk management. McMillan is adamant about position sizing with these more complex strategies. He recommends that spread strategies should represent no more than 2 to 3% of your portfolio per trade, and volatility strategies should be even smaller, perhaps 1 to 2% per trade. He also emphasizes the importance of adjustments. Unlike simple buy and hold strategies, these intermediate strategies often require active management. McMillan suggests having adjustment rules in place before entering any trade. When to take profits, often 25 to 50% of maximum profit. When to cut losses, typically 2 to 3 times the credit received. How to adjust losing positions, rolling strikes, or expiration dates. Common mistakes to avoid. McMillan identifies several common mistakes that intermediate traders make. 1. Over-trading. Don't feel like you need to have positions on all the time. Sometimes the best trade is no trade. 2. Ignoring volatility. Always consider the volatility environment before entering any strategy. 3. Poor timing. Don't enter credit spreads when volatility is low, or debit spreads when volatility is high. 4. Lack of patience. These strategies often require time to work. Don't panic if positions move against you initially. 5. No adjustment plan. Have rules for managing winning and losing positions before you enter the trade. Preparing for advanced strategies. You should now understand the intermediate strategies that form the backbone of professional option trading. These strategies, credit spreads, debit spreads, iron condors, and volatility plays, give you tools for almost any market environment. Next, we're going to explore McMillan's advanced concepts, portfolio hedging strategies, complex multi-leg trades, and his insights on market timing. We'll also cover his risk management philosophy and how to build a complete options trading system. But before we get there, I want you to paper trade these strategies. Start with credit spreads. They're probably the most practical for beginning intermediate traders. Get comfortable with the mechanics, understand how the Greeks affect these positions, and practice adjusting losing trades. Remember McMillan's golden rule. The successful option trader is not the one who never has losing trades, but the one who manages losing trades effectively while letting winning trades maximize their potential. Okay, so we built your foundation and gave you practical strategies. Now we're going to explore portfolio hedging, complex spread strategies, and most importantly, McMillan's philosophy on building a complete trading system. This is where options transform from individual trades into a comprehensive investment approach. Portfolio hedging, protecting your wealth. Lawrence McMillan considers portfolio hedging one of the most important applications of options, yet it's often overlooked by individual investors. As he puts it, the wealthy don't stay wealthy by taking unnecessary risks. They use options to protect what they've built. Protective puts. Your insurance policy. The simplest hedge is the protective put. Buy and put options on stocks you own. Think of it as insurance for your portfolio. Just like you insure your house even though you don't expect it to burn down, you buy puts even though you don't expect your stocks to crash. Let's say you own a diversified portfolio worth $100,000, and you're worried about a market correction. You could buy put options on an ETF like SPY to protect against broad market declines. If you buy SPY puts with a strike price 10% below current levels, you're essentially putting a floor under your portfolio losses. McMillan warns that protective puts aren't free. They cost money and can drag on performance if the market keeps rising. But he emphasizes that the peace of mind and downside protection can be worth the cost, especially for retirees or those near retirement. Collar strategies, hedging with income. A collar combines protective puts with covered calls. You own the stock, buy puts for protection, and sell calls to help pay for the puts. McMillan calls this hedging with income generation. The beauty of collars is that they're often low-cost or even credit strategies. The premium you collect from selling calls helps offset the cost of buying puts. The trade-off is that you cap your upside potential, but you also limit your downside risk. McMillan suggests that collars work particularly well for concentrated positions. Maybe you have a large position in your company's stock, or you inherited a significant position that you can't or don't want to sell immediately. Advanced spread strategies. Now let's dive into some of McMillan's more sophisticated spread strategies. These aren't for beginners, but if you've mastered the concepts from parts 1 and 2, you're ready for these advanced techniques. Butterfly spreads. Precision trading. A butterfly spread is designed to profit when a stock stays very close to a specific price. McMillan describes it as surgical precision in options trading. You're making a very specific bet about where a stock will be at expiration. A long call butterfly involves buying one call, selling two calls at a higher strike, and buying another call at an even higher strike. All options have the same expiration date. The position profits if the stock ends up exactly at the middle strike price. McMillan explains that butterflies are low-cost, low-risk strategies, but they require precise timing in stock selection. They work best when you have a strong conviction about where a stock will be at expiration, not just the direction it will move. Condor spreads. Wider profit zones. Condors are similar to butterflies but with a wider profit zone. Instead of profiting at one specific price, condors profit across a range of prices. McMillan considers these more practical than butterflies because stocks rarely end up at exactly one price. The trade-off is that condors typically cost more to establish than butterflies, but they have a higher probability of success because of their wider profit zone. Ratio spreads. Advanced risk-reward ratio spreads involve unequal numbers of long and short options. For example, you might buy one call and sell two calls at a higher strike. This creates a position that profits from moderate moves but can lose money on large moves. McMillan warns that ratio spreads introduce unlimited risk on one side, so they require careful monitoring and risk management. However, when used correctly, they can provide excellent risk-adjusted returns in range-bound markets. Market timing and volatility cycles. One of McMillan's most valuable insights concerns market timing and volatility cycles. He doesn't advocate trying to time every market move, but he does believe in recognizing long-term cycles and positioning accordingly. The VIX in Volatility Trading McMillan extensively discusses the VIX, Volatility Index, as a tool for options traders. He explains that the VIX typically ranges between 10 and 30 in normal markets, with readings below 15 indicating complacency and readings above 25 indicating fear. As McMillan says, when everyone is fearful, options are expensive and should be sold. When everyone is complacent, options are cheap and should be bought. This contrarian approach to volatility has been a cornerstone of successful options trading. He suggests that when the VIX is above 25, consider selling credit spreads and iron condors. When the VIX is below 15, consider buying straddles and strangles, or at minimum, avoid selling options. Seasonal patterns. McMillan also identifies seasonal patterns in volatility and market behavior. He notes that volatility tends to be highest in the fall months, September and October, and lowest in the summer months. This isn't a guarantee, but it's a tendency that informed traders can use to their advantage. Building a complete trading system. This is where McMillan's book really shines, not in teaching individual strategies, but in showing you how to build a complete approach to options trading. The 3 pillars of success. McMillan identifies 3 pillars that every successful options trader must master. 1. Strategy. Selection, choosing right strategy for the market environment. 2. Risk management, controlling losses and managing position size. 3. Trade management, knowing when to adjust, close, or hold positions. Strategy selection framework. McMillan provides a framework for choosing strategies based on your market outlook. Strongly bullish, buy calls or use bull call spreads. Mildly bullish, sell cash-secured puts or use bull put spreads. Neutral, sell iron condors or use calendar spreads. Mildly bearish, sell covered calls or use bear call spreads. Strongly bearish, buy puts or use bear put spreads. High volatility, expected, buy straddles or strangles. Low volatility expected, sell straddles, strangles, or iron condors. Position sizing rules. McMillan is adamant about position sizing. He recommends that no single strategy should represent more than 5% of your total portfolio, and high-risk strategies should be limited to 2% or less. He also suggests diversifying across different types of strategies and different underlying assets. Don't put all your eggs in one basket, even if that basket is your favorite option strategy. Professional risk management goes beyond just limiting position size. McMillan teaches several advanced concepts. Instead of managing individual positions, McMillan suggests managing your overall portfolio Greeks. If your portfolio has too much positive delta, too bullish, you might add some negative delta positions to balance it out. This is how professional trading desks operate. They're constantly monitoring and adjusting their overall risk exposure, not just individual trades. McMillan warns about correlation risk, the tendency for all your positions to move in the same direction during market stress. Having 10 different iron condors on 10 different stocks doesn't provide much diversification if all stocks tend to move together during market crashes. He suggests diversifying across asset classes, stocks, commodities, currencies, and market capitalizations, large cap, mid cap, small cap, to reduce correlation risk. McMillan acknowledges that rare but extreme events, black swans, can devastate option sellers. His solution isn't to avoid selling options, but to always maintain some long option positions that would profit from extreme moves. As he puts it, the successful option trader is always long some volatility, even when primarily selling options for income. Psychology and discipline. In the final chapters, McMillan addresses the psychological aspects of options trading. He believes that psychology is often more important than strategy selection. Common psychological traps are: 1. Overconfidence. Success can lead to larger position sizes and riskier strategies. 2. Loss aversion. Holding losing positions too long while closing winners too early. 3. Recency bias. Giving too much weight to recent results. 4. Analysis paralysis. Spending too much time analyzing and not enough time acting. McMillan recommends several practices for maintaining discipline. Keep a trading journal documenting every trade and the rationale behind it. Review losing trades to identify patterns and mistakes. Set position size limits and stick to them regardless of conviction level. Have predetermined rules for adjusting and closing positions. McMillan acknowledges that technology has transformed options trading since his book was first published. Modern platforms provide real-time Greeks, probability analysis, and automated adjustment alerts. However, he warns against letting technology replace understanding. As McMillan says, technology should enhance your trading, not replace your thinking. The best platform in the world won't help you if you don't understand what you're doing. In recent updates to his work, McMillan discusses how options trading continues to evolve. The rise of weekly options, the growth of ETF options, and increased retail participation have all changed the landscape. But his core principles remain the same. Understand what you're doing, manage risk carefully, and maintain discipline in your approach. As McMillan concludes in his book, the successful option trader is not necessarily the smartest person in the room, but the most disciplined and consistent person in the room. Whether you're using options to generate income, hedge existing positions, or speculate on market direction, the principles in this book will serve you well. Start with the basics, practice with small positions, and gradually work your way up to more complex strategies. Remember, the goal isn't to master every strategy McMillan discusses. It's to find the strategies that work for your personality, risk tolerance, and market outlook, and then execute them consistently with proper risk management. Thank you for joining me on this comprehensive journey through one of the most important books ever written about options trading. If you found this series valuable, please like the videos, subscribe to the channel, and share them with anyone who might benefit from learning about strategic investing. Until next time, trade smart, manage risk, and always keep learning.